Okay, welcome to the Swing Trading with Cycles channel. It is November 27th. It's Sunday. So the markets are going to be open in about 5 hours, the futures that is. We're going to do our coverage today on the broader markets. We're going to look at the S&P, QQQ, IWM, and the Dow. The Dow is the one that's outperforming. Just a quick reminder, this is all data-driven analysis of the market, specifically the price action, the price data. And we do that by focusing on that price action, open, high, low, close, very data driven, not really looking at classical chart patterns and that sort of thing. We do that on multiple time frames. It allows us to anticipate moves. And then we use cycles to tie everything together to understand how long is something rallied, and therefore how likely is it that there's going to be some kind of turning point, right? And we cover just about everything on this channel. Again, today we're going to do the broader markets, U.S. indices. So for this specific video, we want to talk through the notion of, like, what does the next few years look like, to the extent that we can tell. Obviously, we don't have a crystal ball here, but you've had people come out like Stanley Druckenmiller that says we won't make a new high for the next 10 years. A lot of people are sort of hearkening back to previous time periods, and so where we just kind of consolidated for the most part. So we're going to do 4 things in this video in particular, and all of those are in service of answering that question, right? What is the likelihood that we're going to have this kind of sideways market? And maybe it's not 10 years, maybe it's like just 3 or 4. Even that would be incredibly painful. So we're going to do a year-end 2022 outlook. So we're going to look at the daily cycles, the weekly cycles. How is that stuff shaping up? And I talked about this on Twitter quite a bit. If you're not following, definitely take a look at the link in the description. That the Dow is outperforming. I think everyone's talking about that. I mean, the Dow is like, maybe 8% away from its all-time high right now, whereas other things are like 17, 18% or more, right? And so we'll look at what does that look like. We'll look at a long-term cycle view. So this cycle, that decline that we're moving into, how does that tie into even larger cycles, right? Ones that go back decades. And then finally, we'll look at sector performance, and we'll also look at that with a lens of a longer-term cycle, right? Because some sectors look like they may have already had their long-term cycle low, which is really interesting and important to know about. So let us jump into the charts. So we will start with our review. We'll start with SPX. So we'll start with the daily chart here. So we did make a new high on Friday, slight new high, and that was the day after Thanksgiving. So very light trading on day 30 of the daily cycle, right? So we started this rally here. And so pretty long. I mean, this last daily cycle was actually only 27 days. So this is already longer than the last daily cycle for sure, because we haven't even started a daily cycle decline. And one could argue, wait, was this our little tiny daily cycle low? There have definitely been daily cycle lows that were really mild like that in the past. So you can't rule that out. I mean, we didn't even close below the 10-period moving average, which is what this line is. But it's totally possible. More likely, we're going to decline into a daily cycle low soon. And I've been calling out this gap, right? So maybe we finally make a. So you can kind of see. I'll just draw out this like trend, right? So we went up, down. Well, that's a little too specific. Right, let's say that. That was scary because that was a lower low. And that was also very scary. Right? We do that. Maybe we do something like that and then come down, do something like that. And then it's a question of, does the daily cycle continue this way, right? Or I should say, does the next daily cycle, right? Like you imagine, let's say we get a daily cycle low here, right? And then it's a question of, does the next daily cycle continue higher, right? Making higher lows and higher highs, or do we roll over, right? But the point here is we are short term. We're probably coming into a top very short term, right? Because we're already on day 30. And it's a similar thing that we're seeing for the other indices. But let's move over to the weekly first. Stick to SPX. It was week 6, and we did make a slight higher high, right? So what was that? High at 40.34 versus 40.28, right? So a new high for week 6. And so as we always watch for, when we see a daily cycle decline begin, we always want to be vigilant. Is that daily cycle decline going to also create a weekly cycle decline. That's what we want to be watching for. And our first tell for that would be a weekly swing high. So we're going to watch once this daily cycle low, well, excuse me, once we get what looks like a daily cycle high on the daily chart, we're going to kind of watch how that decline shapes up. So we are going to be watching. We're going to be vigilant at this point. And the monthly chart, the most important, right? We have a potential bottom on month 31, which is October, right? Because we have this like pretty substantial swing low, and we obviously only have a few days trading left for November. So it looks like we're on pace to close November as a swing low of October, right? That said, note that like we had this month that was made a higher high and then kind of reversed violently. We had these months that looked like they were maybe going to make a play. So doesn't mean we're out of the woods by any means, but this might have been meant for the weekly. This little sort of hypothetical candle here is actually a great example of like our next, if we continue on this path, and again we just talked about we're probably going to get a decline, so we're probably going to end up with some wick to close out the month. But if we didn't, it would mean that, we could see a candle like that, something like that, right? Like if we close on the highs, right? That's just an important just feature of candles. The less upper wick you have, the more sort of momentum that next candle has to open and make a kind of higher high, right? So that's your S&P 500. And then the thing about the QQQ and the IWM is that they're actually weaker. So I just mentioned that S&P made a new high on day 30. The Qs definitely did not. So Friday was an inside day of the Wednesday candle, and we still have a high at 293.26, right? And we closed at 286, 287. So and that's not a new thing. It's been weak all along. Tech has been weak in general. When we look at the sector performance, we'll see why. We'll see what is kind of dragging it down. And then on the weekly level, same kind of idea. Whereas S&P made a new, and I'll get rid of some of these lines. It's hard to see. S&P made a new high on week 6, which was this week for Qs. We did not, right? And I drew these lines to show that this was going to, like last week was going to be an inside week of the week of November 14th. And notice we basically stayed an inside week. We did poke down very briefly below, I think that's right below the lows. But we didn't get any follow, and when we went green, but we didn't get any follow through the upside. Really ended up kind of a doji. So kind of in no man's land a little bit. And on the monthly, similar situation to the S&P, except more upper wick you can see, whereas the S&P is on pace to close at the highs. But again, there's a little bit of trading left. For IWM, the small caps, same idea as the Qs. So wait a second. So the Q, well, right, that's interesting. So the Qs are actually a slightly different count. Friday was day 28, but the important point is that we still have that swing high, right? We're still beneath that swing high, whereas the S&P made a higher high already on the daily cycle, and that creates the same exact situation on the weekly where we actually remained an inside week. So the Qs actually made a lower low, like a slight lower low. In this case, we didn't even do that. We just kind of stayed inside the range. That's important to know. And the monthly is almost red, right? It had a little stint being green. It had a little stint being red. It looks like it's trying to go back red. And it opened at 185.24. So if we fall below that level, we would close red, right? So that's not a good sign. So IWM and QQQ definitely underperforming. The one that's outperforming is the Dow. So DIA is the ticker symbol for the ETF that tracks the Dow. So we'll just look at that. And you can see a very strong higher high on Friday at day 30. So this is probably going to pull into a daily cycle low soon. And we're going to be watching it very closely to see, does it hold a higher low? And in this case, I'd say you'd want to hold above 324 at the lowest, right? To give yourself a nice little higher low on the weekly chart, week 6, new highs. And the monthly, the strongest of them all, right? And I would also point out, just flip to the quarterly chart, we make a quarterly swing high above 343.09, right? So this is leading the other indices by far, right? And with that in mind, let's just flip to that now, right? So like let's look at the Dow by itself versus the Dow versus the S&P, right? So this is our two panel setup. On the left hand side, we have the Dow itself, and on the right hand side, we have the Dow divided by the S&P. So if it's going up, it means the Dow is outperforming. If it's going down, it means the Dow is underperforming. Let's flip this to an annual chart. So that is 12, like each candle is 12 months, right? A whole year of price action. And what you can notice from just kind of just that should jump out to you is that we have been essentially up only on the absolute chart, right? Like we have a low at $20, $20.76, and we're all the way up here at 34,000, right? Whereas for the relative chart, it's actually much choppier. And let's just zoom into like the 80s, right? Like let's not give too much credence to like the much older data. So if we zoom into the 80s, you can see, again, it's been kind of up only. You've had a few periods, right? Like you had this 3-year period with the .com bust. So 2000, 2001, 2002, where we were red. Then you had the big 2008 year. And you had these years in 2015 was red, 2018 was red. But you look at the ratio chart, much, much more red, much choppier. And more importantly, it's been in an uptrend until 2008, right? It actually dropped. It's actually been declining since 2008, right? And you can see that from the swing highs. So like these are your swing highs on the way up. That was your final one and notice these swing highs failed, which is to say we eventually made a higher high above them, whereas this swing high did not. It held, right? This swing high led to other swing highs that were lower, right? And so, and I'll zoom into the ratio chart now. And so this is the structure we're kind of looking at the last, call it 30 to 40 years. And we now have a big green candle, whereas we had 3 big red candles. So 2019, 2020, 2021. So again, another way of saying those 3 years, the S&P massively outperformed the Dow, right? You would have been better off to have your money in the S&P versus the Dow. Same thing for these 4 years, right? And so this has been kind of a choppy mess. You could say that this is just chop, and I'll even kind of draw, like you could argue that's just kind of a consolidation zone, right? And again, this is a ratio chart, so it's not telling you anything about absolute prices, but we then kind of broke down from that consolidation box, but now we're springing back up. And most importantly, I'll just call out, we have a yearly swing low in place. That's incredibly bullish, right? Boom. Now, to be fair, that's also a yearly swing low. That's a yearly swing low, right? And you can see this one led to a lower low, right? And that one led to a lower low. So a swing low is no guarantee that we're off to the races, higher highs, higher highs, higher highs. But notice we did get follow through for at least a few years after these other yearly swing lows. This is another big yearly swing low in the year 2000, right? Now, you could certainly see a period where they both go down, right? The Dow and the S&P go down, but the Dow goes down less. So that's the thing about the ratio charts. You have to take them with a grain of salt, have to kind of understand what the absolute charts are doing. But this tells you that we could be in a period, we could be setting up for a period of 1 or 2 years of, outperforming. Now, that doesn't mean we couldn't still be in a sideways market. So let's make sure we definitely want to address that. So let's look at the S&P very long term. Right, so just kind of going back. Sorry, I'll do that. So looking at the S&P very long term. Again, this is your annual chart, and of course, this data is kind of stitched back together to kind of reconstitute the index because it didn't actually exist in 1929. But we're really just using this as a proxy for the market as a whole, and you can see the major swing lows, right? And as I always talk about, we don't like there's no reason to think that there's something mystical at play, sort of thing, right? In terms of the cycles, like something has to happen every X number of years or something like that, right? We're just taking the price action for what it's worth, right? And we're marking the swing highs. And if you've seen the video where I talk about swing highs, this might seem familiar to you because we kind of walk through this a little bit. And so let's just think about the timing band here, right? This is going to be really interesting. So how long have we rallied, and let's just see what those rallies have looked like in terms of percentage terms, right? So let's call this a bottom because, like, this is a bottom of all this stuff, right? So this rally from this to this, to that swing high, that lasted 31 years, right? Okay, that's good to know. And then we got a pretty quick swing low. Like this is just a little squiggle almost, right? But like, because obviously this is a big decline. And then let's say, so that's your rally. Yeah, like I don't even know if you would call this a major bottom, right? But like, let's actually start, and I'm obviously doing this kind of off the cuff. Let's say from here, right, which is 1975, you could call that all one cycle, right? That makes a lot of sense, right? Like, just look at that. Let's make this shorter so that we can actually see the price bars. Let's see, it's 34. So this whole period, and you could say, oh, wait, wasn't this a cycle low? But maybe this is just a halfway point, and this is your .com bust, and then this is your global financial crisis to kind of finish you off, right? And so that would mean that this rally lasted 31. How many years was that? So 26. So that would mean that we rallied for 26 years. And then we decline. Really, this is more of a sideways kind of situation for, almost 10 years, because this is 35 years. So, but again, there's nothing mystical about this that means, okay, well, now this thing needs to go for another 5 years, this needs to go for another 35 years, for instance. But like, you can see just structurally, this rally, which topped out this year, 2022, in year 12, it's like, so here's the good news and the bad news, the way you want to kind of think about it. We could be, like, imagine if we did have another, let's just call it 30 years, right? Let's just call it 30 years even, right? We're talking really hypothetical here. We're just speculating. We could have a situation where, wow, it's 2039, right? That's interesting. So you could have a situation where that is your ultimate, another big cycle low, which could mean that we can make much higher highs from here. And who knows where that cycle low kind of ends up. And then if we think about this period, right? Like, my eye would draw this like that. I mean, that's like a really, I guess the way you think about this cycle, if you want to call it a cycle, is it's really bullish, right? Because it's like we top out really close to the end, but like let's just leave that for what it is, right? Let's say that's a cycle of about 32 years, and that's after this swing low here in 1942. So this is like our recovery from the Great Depression, and you could say this is a cycle right here. And we'll zoom in to make sure we can all see it. So that's the thing. If you call it from here to here, and so I'm doing this in real time, so apologies. I'm obviously adjusting, right? Like if you say this is the beginning of your cycle, well, that's interesting. Yeah. Like what would that be? That's really short. And that's why, again, these are not perfect. So you could call this a 40-year cycle, right? Now, again, this doesn't really make sense as much. Like, wow, only a 2-year decline off of such a long-term cycle. But you could see a world where either way, no matter how you kind of slice it, we're basically 12 years into a longer-term cycle, right? And how long that cycle is, again, is a matter of speculation, and we're going to have to see it play out. But that puts us in the uncomfortable position that it could be sideways until we could go significantly higher and then drop into a cycle low, in another decade, or we could just chop around for another decade quite easily as well. I guess the good news is the sectors aren't going to necessarily perform the same. Let's jump to that really quickly. Let's look at what the sectors are looking like in absolute terms. So these are the sectors. We have XLY, consumer discretionary, and this is your annual chart. And you can see this is pretty bearish, right? We are still below last year's low, right? XLV, which is healthcare. This might be a little bit hard to see because of that text up there. We're actually trying to go red for the year, so that's actually pretty bullish. So put healthcare in the bullish camp. Utilities, similar kind of thing, kind of trying to go red, or green, I should say, for the year. Real estate, pretty bearish. I mean, look at this ugly candle. XLP, one of the most bullish, trying to go green. XLK, one of the more bearish, pretty red, almost below last year's low. XLI, industrials, and certainly there's a notion that we have late cycle movers, and so some of this move can reverse, and so we're going to have to watch for that. But this is how it stands right now as we're trying to close out the year. XLI is trying to go red. It's building a hammer. And XLF, which is the financials, that's also trying to build a bit of a hammer. So you get, I'll just kind of paint, I'll paint these. So I'll say this is red for ugly. XLV is green. And we'll just say green is in relatively speaking. That is real estate is red. XLK is red. XLP is green. And XLI was green. All relative, obviously. XLF also green, which is not to say that they're green for the year, but they're doing better than some of the other sectors. So this really lets you see what's pulling the S&P down, and you can see XLE doing really well. So that gets a green star, which is no surprise. That is energy. XLC, that's the thing that holds Facebook. This is the worst performing. I mean, look at how far below last year's low it is, right? So that is a big fat red. I mean, the worst by far. XLB, which is materials, trying to build a little hammer. So I'd say that's green. And that's the extent of the S&P sectors. So you can see if I just scroll through these, XLY, so consumer discretionary, which is XLY, real estate, XLRE, XLK technology, and XLC, which is communications. That's got Facebook and those kinds of folks in there, other social media plays. Those are all very red. And you can see the more materials names, healthcare, utilities, staples, those are all doing better, right? So that's important. That tells you how the market is positioned. And again, that could reverse. It could be a late cycle thing that's kind of being unwound. And I also just added a couple of other just subsectors. So SMH, that's semiconductors. So that falls within technology. And you can see not doing amazing, but it's trying to get back above last year's low. IGV, which is also technology. This is software, way below last year's low. So you can see that's pulling down technology. XME is metal, is metals and mining. That's doing really well. That's actually green for the year. One of the few subsectors that is. And then you have silver and gold, which we talk about extensively in other videos. Those are both red for the year, but not doing much worse than the S&P itself. And on that note, that's where we'll jump to the ratio charts. We'll look at all these by ratio. So let's look at the 12-month chart again. So it's the same sectors, but now we're looking at the sector divided by the S&P. So I know this is a lot of information, but I think this is actually really important. So XLY we knew was bearish in absolute terms, and it's pretty bearish on the ratio. That makes sense. We know it looks bad relative to its peers, its other sectors. XLV, nice outperformance on the ratio chart. That's actually a swing low. And again, this is a 12-month chart. XLU, important to note, has been in a downtrend since 2008, and it's now poking its head up. So this might end up being a lower high. I would be careful here, just like these were lower highs. Real estate is in a pronounced downtrend, and this is a ratio chart, but like, it's made a bearish outside year, so that is, I would stay away from that. XLP has been in a downtrend similar to XLU since 2008. So again, I would be careful here. This could just be another lower high, the way this was a lower high and that was a lower high. So I'd be really careful there. XLK, this is an interesting one, right? We had this huge move lower since the 2000 crash, which makes sense. Then we based for several years, and then it's been massively outperforming the S&P since 2015. And now we have this red candle. This could end up becoming a higher low when we keep pushing higher. But for now, XLK is obviously underperforming the S&P. And then we have XLI, which has been in a downtrend since 2018 and is now kind of poking its head up. Again, these are annual candles. And finally, XLF, which has been in the downtrend since the global financial crisis. This one looks really tenuous. Like, we have to get above all of this stuff first before we could even think about this. And obviously, again, this is a ratio chart, so it doesn't tell you about the absolute prices, but it tells you you really haven't wanted to be an XLF relative to the S&P for a long time. Like, this is a really ugly chart. And if we look at the other sectors, let's look at XLE. So big downtrend for many, many years, and it's now trying to reverse. So there is a possibility that this becomes a lower high. There are obviously fundamental tailwinds for energy, though. XLC, God, just so ugly, so ugly. XLB, big downtrend again, starting to reverse. So we're at this important pivot point where there are a lot of things that have been in massive downtrends versus the S&P that are now going green, right? Now have swing lows on the yearly chart. What does that mean? Is that a regime change? Is that capital flows rotating, or is this a move that's going to get snuffed out? The SMH chart looks exactly like the XLK chart, except it's a little bit weaker. We made a much lower low than the XLK chart. So this is because this is a subsector of technology, that makes sense. This is IGV, the software. Again, bearish on the absolute chart, and look at this swing low, man. Like below that level, just not something that. And it had an amazing run versus the S&P. It's just starting to kind of come to an end a little bit. I mean, you can see gold and silver again. So like green for the year finally after a lot of underperformance. So you can see the sectors that are starting to kind of come to life. And as we think about that, we'll go back to the sector performance and we'll look at a monthly chart. And let's just think about, are there sectors that, or excuse me, not the ratio charts, but the absolute, right? Are there sectors where it's possible we've already printed a long-term cycle low, right? So this is XLY. Well, for the ones that are bearish, we know that's probably not the case. But for something like XLV, right? Is it possible that this was our long-term cycle low? It's also important to note that this one topped out, right? So this one has rallied for much longer than the S&P was able to rally on its own, right? We know the S&P rally tapped out in month 22, which was January. This one topped out on month 25. So that's important to know about, right? What else is another one that's pretty XLU? So this actually didn't top out until month 30. That's interesting. XLP. That tops out on month 25. So similar trajectory to XLV, right? To healthcare. XLI. These are monthly charts again. So that top comes in. So that actually came. Oh, actually, we made a higher high in January. So this actually topped with the market, but it was really a double top kind of situation. XLF topped in January, so same as the market. But you're coming into so XLF is a perfect example where you're coming into a situation where, is it possible that, you know, that was your high at month 22 and then this was your low? And obviously we looked at the S&P chart where we possibly have a low in October as well. But for the ones that are outperforming, it starts to give you an inkling. Is there a world where we get a major cycle low for a sector of the S&P while the S&P itself continues to kind of roll over? That's what we're going to want to watch for. And as we think about, like, as we watch to see if we're going to see more sideways action for next year, we start to think about, what sectors would we want to rotate into that may outperform, that maybe do make all-time highs? Maybe they've made a long-term cycle low earlier, and now they're going to come back around and make an all-time high, right? That's the way that we want to start to kind of think about it. And on that, like in that vein, if we look at the SPX chart and we flip to a 12-month chart, we know that the range for next year is the range for next year is not going to be a surprise. It's very clear because, well, anything could happen in December, I suppose. Well, yeah, I guess we could certainly make a new low in December. But assuming nothing crazy happens, we're probably going to close the year inside the range that we've already made for the year. So this year we had a high at 48.18 and we've had a low at 34.91. Now, I think it's certainly orders of magnitude more likely that we'll make a new low versus a new high. But I think it's probably, I don't know, we'll have to see. If we get a really intense downdraft, we can certainly make a new low. But assuming we don't make a new low, we're going to end up opening as an inside candle, right? And so the way a decade, or just let's forget the decade number and just call it a multi-year period of no new highs would look, it would look something like this, right? Like imagine a world where we just consolidate, and it doesn't have to be inside the range of this year. We could certainly break down, right? Imagine you get a bit of a range expansion, right? Like that's actually probably more likely, right? That you start to kind of test the lows, maybe tease the highs a little bit. Like you could see a world, and this is like rampant speculation right here, but this is what it would look like visually. And it would be incredibly frustrating for a long-term investor. And that's why you'd have to be nimble. You'd have to understand which individual stocks maybe. Well, you start with sectors, I would say, then maybe what individual stocks. But you also, there's that notion of making sure that you're kind of trading around, or at least I certainly will be, sort of trading around the kind of edges, right? Like as you zigzag, right, there would be opportunity to profit. Even if you're not making all-time highs, you can profit from the swings, right? So it would be great to be able to say definitively, here's the crystal ball, we're going to do this. It's impossible to say, but what we do know are what the levels are, what levels we could consolidate within, and how we could see a range expansion. So we have a sense of what it might look like and what to watch for as everything unfolds. And equally important, that sector level performance. So I know that was a lot of information crammed into this one, so we will leave it at that. A very thorough update. I'll continue to give updates, especially on the sector level performance as we see that rotation. But thanks again for watching this installment.